Are you interested in finance? Want to understand what's happening in Belgian corporate finance? Dreaming of breaking into investment banking, M&A, or private equity? Then the Finance Show is for you. Every 2 weeks, we break down the most important corporate finance news in Belgium and around the world. We bring you expert insights, career advice, and the stories behind the deals that shape our economy. Whether you're a student looking to break in, a professional staying sharp, or simply curious about the world of finance, this is your access point to Belgian corporate finance.
Hello and welcome back to the Finance Show, the podcast that helps you stay on top of corporate finance news in Belgium and around the world. And today I'm joined again by Manon. Thank you for being here and welcome, Manon.
Thank you, Maxime. Happy to be here. So, what's on the menu today?
We have 3 stories. First, another major Belgian pharma deal. UCB is back in the news 2 weeks after the last deal, this time acquiring a US biotech for up to $2.2 billion to push deeper into next-generation immunology. Second, a textbook private equity story. Equity is buying back Desotec, a Belgian environmental services champion, from Blackstone for around 2 billion euros. And finally, on the global side, the biggest hostile takeover battle in European banking right now, UniCredit has officially launched its 35 billion euro bid for Commerzbank and Berlin is fighting back.
Sounds like a lot to unpack. As always, we'll explain the technical terms along the way. So, even if you're new to corporate finance, you'll be able to follow. And we'll also drop a few interview tips for those of you preparing for IB, M&A, or PE applications.
Let's get into it.
2 weeks ago, we covered UCB buying Candid Therapeutics for up to $1.15 billion. They're back already. What did they announce?
You're right, and this one is bigger. May 3rd, UCB signed a deal to buy Candid Therapeutics, a San Diego biotech. Total value up to $2.2 billion, $2 billion upfront in cash, plus up to $200 million in milestone payments.
Same structure as Neurona, upfront plus milestones, but almost double the size.
Right, and here is the number every analyst should pay attention to. This is UCB's third acquisition in 2 months. March was a deal with Antengene, a Hong Kong biotech. April was Neurona. May is Candid. Added up, you're well over $3 billion committed in roughly 60 days. For a company that historically does maybe one big deal per decade, this is a complete strategic shift.
Can they actually afford this?
That's the first question I asked myself. So I pulled their 2025 annual numbers. Look at this. End of 2024, UCB had 1.45 billion euro in net financial debt. End of 2025, that flipped to 7 million euros in net financial cash. Effectively, zero net debt. Net debt to adjusted EBITDA ratio is even 0.0x.
Wait, they wiped out 1.5 billion in debt in 1 year?
Strong operating cash flow, voluntary loan prepayment of 645 million euros, and a favorable foreign exchange impact on outstanding debt. So when the CEO Jean-Christophe Tellier said in February that they could explore external growth, he wasn't bluffing. He had the cleanest balance sheet UCB has had in years, and he immediately deployed it.
Quick reminder on net debt for listeners.
Net debt is what you owe minus the cash you have. If you have 100 of debt and 100 of cash, your net debt is 0. That's UCB's situation today. It means they could borrow several billions more without stressing the balance sheet. That's the dry powder behind the shopping spree.
And what is funding this cash machine?
Mostly one product. It's called Bimzelx. Sales jumped from 607 million euros in 2024 to 2.22 billion in 2025. That's plus 200% in 1 year. UCB is targeting peak sales of at least 4 billion euros, and they are already halfway there after only 2 years on the market. Total company revenue grew 26% to 7.7 billion euros.
What is Bimzelx in plain terms?
It's a treatment for psoriasis and a few related inflammatory disease. You don't need to know the science. What matters financially is one thing. It's a blockbuster and it's growing fast. In pharma, blockbuster means a drug doing more than 1 billion in annual sales. Bimzelx blew past that and it's now scaling towards 4. It's the engine paying for everything UCB is doing right now.
Okay, so back to Candid. What did UCB actually buy?
Candid was founded in late 2024. It's barely 18 months old. UCB paid $2 billion upfront for a company that's a year and a half old. That's really interesting there.
That sounds expensive.
It does, but here is the way to think about it. They are not buying revenue because Candid has none. They're buying a drug pipeline. The lead drug is called sisutamig. It targets autoimmune disease like lupus and rheumatoid arthritis. These are conditions where the immune system attacks the patient's own body. The current treatments mostly manage the symptoms. Sisutamig tries to actually reset the system. If it works, it's a generational drug.
And how far along is it?
Early stage, phase 1 trials, which means small study on a limited number of patients, and it's still years away from the market. So there is a real chance it never gets approved. It's high risk, high reward bet on early science. UCB is essentially saying we have the cash, we have the immunology expertise, and would rather buy a promising bet now than wait until it's proven and pay 10 billion.
And there's an interesting financial angle on Candid itself, right?
Yes, this is the part I find the most interesting from a deal making perspective. Candid was about to go public. 2 months ago, they announced they would list on Nasdaq through what's called a reverse merger with Rally Bio, a small biotech already on the stock exchange. And a quick definition on a reverse merger, it's when a private company merges with a listed shell to skip the traditional IPO process. It's faster and cheaper.
And then UCB stepped in?
UCB intervened literally the day after Candid secured the Nasdaq deal. So UCB outbid the public market and took the company private before it could trade. This is what bankers called a preemptive bid. It tells you two things. One, UCB had strong conviction. Two, there were probably competitors circling. When you preempt, you pay a premium to make sure no auction starts.
And there's another angle that usually doesn't get covered.
Candid drug pipeline isn't fully homegrown. The lead drug, sisutamig, was licensed from a Shanghai biotech called Epimab. A second drug was licensed from another Chinese company, Jenner Biopharma. So Candid is essentially a US-based repacking vehicle for Chinese biotech innovation.
What does that mean concretely?
Chinese biotechs have built enormous drug pipelines, often at a much lower cost than American or European companies. Western pharma is now systematically buying or licensing from those programs. UCB Antingene deal in March follow the same logic. So when you see the headline UCB buys a US biotech for $2 billion, the deeper story is that UCB is paying for Chinese science with a US clinical wrapper around it. That's a major industry trend that almost nobody outside pharma talks about.
Why is UCB doing this whole spree now?
Patent strategy. Drug companies have a clock. When a drug's patent expires, generics flood the market and revenue collapses. UCB's older drugs are aging. Bimzelx funds the next decade. After that, they need a new wave. These three acquisitions are the bet on what comes after Bimzelx.
Quick takeaway for listeners interviewing in pharma M&A or healthcare investment banking?
Three things. One, don't talk about the deal price. Talk about deal capacity. UCB went from 1.45 billion net debt to zero in 1 year. That's what enabled the spree. Show you understand the balance sheet, not just the headline. 2. Mention the Chinese licensing layer. It's the most under-discussed dynamic in pharma M&A right now, and it will make you stand out. 3. Frame the strategy as patent cliff defense. Bimzelx speaks, then what? That's the question every pharma CEO is answering. and UCB is answering it with the checkbook.
Advisors on the deal?
Yes, Lazar for UCB, with Cavington and Burling as legal counsel, Jeffries and Goldman Sachs jointly advised Candid, and BofA also provided financial advice. Cooley on the legal side. Notice Lazar for UCB this time, after BofA on Neurona. UCB is rotating advisor deal by deal, which is interesting in itself.
On to story 2. Another big Belgian deal, but a completely different world. Private equity this time.
Yes, and this one is fascinating because the same company has been passed around between private equity funds 3 times now. November 21st, Equity announced it's buying a majority stake in Desotec from Blackstone. Deal value around 2 billion euros including debt. Closing is expected first half of 2026.
Who is Desotec exactly?
Desotec is based in Roeselare, West Vlaanders, founded in 1990 by 3 Belgian entrepreneurs: Bart Sobry, Joost de Smet, and Peter Sobry. The business sounds boring on paper, but it's incredibly profitable. They rent mobile filters to industrial clients. Big metal containers filled with activated carbon. The carbon traps pollutant from air, water, and soil. Once it's saturated, Desotec swaps the container, takes the dirty one back to Roeselare, regenerate the carbon in their own ovens, and ships it out again to another client.
So it's a rental model?
Exactly. That's the key to the valuation. They call it filtration as a service. The client doesn't buy equipment, doesn't manage carbon waste, doesn't deal with regulators. They pay a monthly fee, and Desotec handles everything. Today, they have over 2,000 customers and the world's largest fleet of mobile activated carbon filters.
Why does the rental model matter for the price tag?
Because it generates recurring revenue. In private equity, that's gold. A company selling equipment one time gets valued at maybe 6 to 8 times EBITDA. A company with sticky monthly contracts and 95 plus clients retention can be valued at 15 to 20 times. Desotec sits in the second category. Same revenue, much higher multiple, just because the cash flows are predictable.
Okay, now this is the third time Desotec changes hands?
Yes, and this is the nice part of the story. Let me walk you through it. In 2009, a Dutch private equity firm called AAC Capital Partners bought a majority stake from the founders. Then, in 2017, EQT, a Swedish private equity giant, bought Desotec from AAC. Then, in 2021, EQT sold it to Blackstone, the world's largest alternative asset manager, and now, in 2025, EQT is buying it back from Blackstone.
So Equity is buying back a company they already sold 4 years ago?
Exactly. And here is a detail almost no one outside the deal is mentioning. EQT never fully exited. When they sold to Blackstone in 2021, EQT kept a 15% minority stake through a different fund called EQT Mid-Market Europe. Now EQT Future, which is a newer fund within the same group, is taking control. So EQT is effectively passing the asset between 2 of its own funds.
Is that legal?
Completely. It's called a continuation or fund-to-fund transaction. The reason it happens, and listeners should really understand this, is that private equity funds have fixed life, usually 10 years. After that, the fund returns cash to its investor, the pension funds and insurance company that put money in it, for example. So when a great asset reaches the end of its fund life, 2 things can happen. Either you sell it to someone else, or you transfer it into a newer fund. Pension funds in the original fund get their money back. New investor in the new fund get exposure to a proven asset.
And the asset itself just keeps growing.
Exactly. Look at the value progression. AAC bought Desotec around 2009. Equity bought it in 2017, estimated value around 350 million. Blackstone bought it in 2021, estimated around 1 billion. And now equity buys back at around 2 billion. So the value has roughly doubled every 4 years, for 16 years.
And the operating story behind that growth?
Two things. First, equity and then Blackstone invested heavily in the fleet and in regeneration capacity. Desotec built new ovens, opened a Polish plant, then Italy, Spain, and in 2023 they entered the US. So the geographical footprint expanded. Second, and this is the macro story, regulation has been their tailwind for 15 years.
What do you mean by that?
This is the investment thesis. Desotec is a regulation play disguised as a filtration company. Every time the EU tightens an environmental rule, Desotec's market grows automatically. The biggest one right now is PFAS. PFAS are called forever chemicals. They are synthetic substances used in non-stick pans, waterproof clothing, firefighting foams, and they don't break down in nature. So they accumulate in human bodies and water supply.
And the EU is banning them?
Tightening dramatically. As of January 2026, the EU has now mandatory PFAS limits in drinking water. The European Chemicals Agency is finalizing its opinion on a near total industry PFAS ban. And the Commission's own study estimates PFAS pollution will cost European society 16 trillion euros if nothing is done. Activated carbon filtration is one of the few proven technologies to actually capture PFAS. So you can guess what's happening to Desotec order book.
That's why equity is willing to pay 2 billion.
Exactly. Plus, the US market just opened. The Environmental Protection Agency announced its first nationwide PFAS drinking water standards in 2024. American industrials suddenly need filtration solution, and most don't have providers. So Desotec entered in 2023 with first mover advantage.
2 co-investors joined this round. Tell us.
Yes, two German family offices, Athos and Merkel. Athos is the family holding of Strungman Brothers, the founders of Exal, the German generic drug giants. They were also the very first investor in bio and tech. Merkel is the holding of Merkel family, owners of pharma group Ratio Pharm. So you have two of Germany's wealthiest healthcare-related families putting money alongside equity. That's a strong signal of conviction in the environmental services thesis.
Thank you for the second story. Moving on to the global one. Maxime, last story takes us out of Belgium, the biggest corporate finance story in Europe this week. What's happening?
This is the most important M&A battle in European banking right now. UniCredit, the Italian banking giant, formally launched its 35 billion euro hostile takeover bids for Commerzbank, the second largest private bank in Germany. The offer document went live Tuesday, May 5th. By Thursday, the Chancellor of Germany called it unacceptable. Friday, Commerzbank fired back with a 38-slide investor deck, raised profit targets, and a 3,000 job cuts. 3 news in 3 days.
Quick reminder, what's a hostile takeover?
A takeover is when a company tries to buy another. Friendly means both managements agree. Hostile means the buyer goes directly to the shareholders of the targets, bypassing the management team. The target's board doesn't want to sell. The acquirer says, forget the board, I'm asking you shareholders directly. And that's exactly what UniCredit is doing now.
And the structure?
This is an all-share offer with no cash. Commerzbank shareholders are offered 0.485 UniCredit shares for each Commerzbank share they tender. The implied price is around €31 per share, and the total package values the deal at about 35 billion euros.
Why all share instead of cash?
2 reasons. First, when you pay in your own stock, you don't burden balance sheet cash. UniCredit is asking its own shareholders to approve issuing up to 470 million new shares. Second, it lets target shareholders participate in the upside if the merged group performs well.
And how is the offer doing?
Badly on the surface, but really well underneath. Commerzbank stock currently trades at around 34 euros. The offer values it at 31. Since the offer was announced on March 16, it has consistently traded above the implied offer price. Commerzbank own deck show that gap has widened to almost 9% discount.
Wait, who would accept an offer below the market price?
Almost nobody. And that's the entire point. UniCredit isn't trying to buy 100% of Commerzbank. They are playing a more sophisticated game built around 30% threshold under German law takeover.
Can you explain that?
In Germany, if you cross 30% ownership of a listed company, you must launch a mandatory tender offer for all remaining shares. So 30% is a cliff edge. UniCredit currently sits at 27% directly plus 9% in derivatives. They want to push direct ownership to above 30% without triggering full takeover obligation. The low offer price almost guarantees few shareholders will tender. UniCredit gets across the threshold cheaply, and in 2027, they can buy more shares freely in the open market.
Can you tell us about Orsol briefly?
Andrea Orsol might be the most respected investment banker in Europe. Former head of UBS Investment Banking, he advised Santander on its acquisition of ABN AMRO in 2007, the largest banking deal in history. He took over UniCredit in 2021. Since then, the bank has delivered 21 consecutive quarters of profit growth and reached a cost-to-income ratio of 38%, one of the lowest in European banking.
Quick definition of cost to income ratio?
It's how many cents you spend to generate 1 euro of revenue. A ratio of 38% means you spend 38 cents to make 1 euro. Lower is better. European banks are typically around 50 to 60%, so 38 is really good.
And Commerzbank's defense?
Commerzbank published a 38-slide investor presentation specifically titled Perspectives on UniCredit Offer. This is worth knowing it exists because it's a masterclass in defensive M&A communication. 3 big moves.
Walk us through them.
First, fact check UniCredit point by point. UniCredit said Commerzbank was operationally underperforming. Commerzbank shows profitability improved by 5 billion euros over 5 years and they exceeded their previous targets. UniCredit says Commerzbank was overexposed to risk and needed 500 million more provision. Commerzbank shows their non-performing loan ratio is 1.1% versus 2.7% for UniCredit. Better quality, not worse. Second move, raise the bar. New strategy called Momentum 2030. Profit target 5.9 billion euros by 2030. Return on tangible equity of 21%. Cost to income ratio down to 41%. They commit to returning more than 50% of their current market cap to shareholders between 2026 and 2030 through dividends and buybacks.
Can you define return on tangible equity?
ROTE, return on tangible equity, measures how much profit a bank generates relative to the tangible equity invested by shareholders. It strips out goodwill and intangibles. For European banks, double-digit ROTE is good, 15% is great, 20% is exceptional. Commerzbank targeting 21% by 2030 is aggressive and meant to make UniCredit offer look obviously inadequate.
And the 3,000 job cuts?
That's the third move. Restructuring cost of 450 million euros plus 600 million euros invested in AI through 2030. The message is that they can deliver more solo than UniCredit can pay, and that they're ready to execute the painful side of restructuring themselves.
What about valuation?
Here is the killer slide in Commerzbank deck. They show 7 different valuation reference points. UniCredit's offer is 31 euros, the 3-month volume weighted average is 34, the 52-week high is 38, broker target price is 39 for the median, and the discounted future share price under their own plan is over 50. So every reference is above the offer.
Plus, they show a comparison of past bank takeover premiums.
Yes, brilliant. Successful European bank deals paid premiums of 38 to 45%. Umicore's offer, negative 9%, meaning a discount. They literally compare it to UniCredit's own failed bid for Banco BPM, which had a 1% premium and didn't go through. The implicit message is that a low premium offers fail.
Quick takeaway?
3 things. 1. Hostile M&A in regulated industries is rarely about full control. It's about influence, optionality, and pressure on management. 2. Defensive M&A presentation are teaching artifacts in themselves. Commerzbank deck is a textbook on how to defend a bank, and it's worth looking at it. 3. The political dimension matters, but legal mechanics usually win in the EU. Time, capital strength, and patience are the weapons. Orcel has all 3.
That's a wrap for today. 3 deals, 3 different angles. A Belgian pharma doubling down on its acquisition spree to prepare for life after Bimzelx. A private equity giant buying back an asset it sold 4 years ago to ride the PFAS regulatory wave. And a hostile cross-border banking takeover that's testing the limits of European integration.
What I want you to remember in this, behind every deal there is a logic, a structure, and a risk profile. As future finance professional, your job is to read between the lines. Why this target? Why now? Who pays what? And under what conditions? And what could make the deal fall apart? If you start watching the news with that lens, you will be way ahead in your interviews.
Speaking of which, if you're a student in Belgium looking for finance internships or jobs, check out the Finance Show tracker on our website, thefinanceshow.com. It's an Excel file we update every week with the latest opportunities in IB, M&A, PE, and equity research across Belgium and the Benelux. Sign up with your email and you'll get it directly, plus a notification every time a new episode drops.
Thanks for listening. If you enjoyed this episode, follow us on Spotify, Apple Podcasts, or Amazon Music, and share it with a friend who's also trying to break into finance. See you in 2 weeks for episode 8.
Take care, everyone.